On paper, the American economy looks remarkably stable, but underneath the headline numbers, the actual structural base is cracking under intense pressure. The primary metric used to declare economic health is gross domestic product, or GDP. Right now, it's growing at a steady clip of approximately 4%. This split-screen visualization shows the growing disconnect. On the left, you see that steady 4% GDP growth. On the right, a cascading wave of mass layoffs in major corporations, with Amazon cutting 16,000 jobs and UPS slashing 30,000. The velocity of these job losses is accelerating, hitting 108,000 layoffs in January alone. That equals 3,500 people losing their jobs every single day. The mainstream consensus tends to brush this off as a temporary sectoral rotation, just tech and logistics rebalancing after pandemic hiring sprees. However, the data points to a mechanical breakdown in how fiat currency flows through the system. To understand this divergence, we have to view the data through the Austrian business cycle theory. This is an economic framework developed by Ludwig von Mises that explains how changes in money supply distort the natural economy. According to this theory, the root cause of our current breakdown is the prolonged artificial suppression of interest rates, combined with aggressive expansion of the money supply. This policy originates directly from central banks printing money to maintain systemic liquidity. When fiat currency undergoes massive expansion, it forces capital into poor investments, which mathematically engineers a K-shaped economy. The inevitable result of this distortion forces wealth out of the fiat system entirely, driving it into physical assets with rigid, unchangeable supplies. The baseline pressure on the system starts with the United States accumulating $38 trillion in national debt. Historical studies of sovereign debt indicate a mathematical point of no return when national debt reaches 100% of a country's gross domestic product. This graph tracks combined U.S. debt against GDP, blowing past the 100. Because the system is no longer anchored to a gold standard, managing this historic debt burden requires printing an infinite supply of new dollars to buy those bonds. We can track exactly how this infinite liquidity interacts with the economy, using the framework established by Mises. The core premise of the Austrian business cycle theory is that artificially low interest rates do not stimulate the entire economy evenly across all sectors. This flowchart maps the structure of production. When the central bank injects cheap liquidity, it enters at specific points. That massive influx of discounted capital flows aggressively into capital-intensive industries equipped with advanced technology, like artificial intelligence. The financial rationale is straightforward. High-tech growth sectors benefit the most from low interest rates because their valuations rely heavily on discounted future cash flows, making cheap borrowing highly profitable. Meanwhile, traditional labor and manufacturing sectors receive almost none of that investment.
The people working those jobs do not have access to these heavily discounted borrowing rates. Austrian economists define this exact misdirection of capital as malinvestment. Malinvestment is the allocation of resources into unprofitable or unsustainable long-term projects due to distorted price signals from artificial credit expansion. This mechanism artificially stretches the entire structure of production, systematically starving the working class of capital while enriching specific asset-heavy sectors. That systemic malinvestment creates a direct societal outcome, the K-shaped economy. This diagram shows how economic recovery paths diverge, creating a literal K-shape across the population. The upward trajectory represents asset owners, stockholders, and tech-first movers. Their wealth expands rapidly, leveraged by cheap capital flowing from the central bank. The downward trajectory represents the working class. Locked out of leveraged capital markets, they face stagnant employment and declining real wages. Then, the delayed variable of mass money printing hits the broader system, general price inflation. Because median income earners lack the large investment portfolios that benefited from the initial low rates, this inflation acts as a regressive tax, aggressively eroding their real standard of living. The K-shape is a mechanical feature of the system. It is the mathematical transfer of purchasing power from wage earners who use the currency directly to the institutions holding the assets. Faced with mathematically guaranteed fiat dilution and K-shaped stagnation, smart capital looks for an exit.
Investors desperately seek a reliable escape valve by rotating their wealth into hard, physical assets that governments simply cannot print. Historically, the most reliable escape valves are the precious metals markets of gold and silver. This microeconomic chart illustrates why these metals are a reliable counterasset. Both the supply curve and the demand curve are highly inelastic. Inelastic means that the quantity supplied or demanded does not change significantly when the price changes. The supply of gold and silver is strictly constrained by the physical limitations of mining and recycling. You cannot generate thousands of tons of metal with a keystroke. At the same time, the baseline human and industrial demand for these metals remains incredibly rigid over long periods of time. Now, a massive external demand shock is hitting this rigid market. Global central banks are actively turning away from U.S. Treasury bonds. These central banks have aggressively retreated from dollar-denominated assets, pushing gold to constitute over 50% of their total asset reserves. There is also a secondary demand shock occurring, as younger, risk-tolerant demographics rotate out of volatile cryptocurrency markets and seek diversification in physical metals. When massive new international demand collides with a perfectly inelastic supply constraint, the outward shift generates a violent, structural increase in price. This brings the macroeconomic theory straight into the current explosive reality of the silver and gold markets. The upward momentum in precious metals tracks the systemic impact of broad currency expansion. Investors are measuring an exponentially growing fiat supply against a rigid physical bedrock. This trajectory highlights the vulnerability of a dollar-based economy struggling with historic levels of debt and the erosion of purchasing power. Ultimately, the shift into gold and silver marks a mechanical attempt by the market to re-establish the stability that historically anchored the monetary system.